It's funny, I went to all this trouble to build like a video studio in my office, and here I am recording a video outside the tennis lessons my son's taking at 7 a.m. So this post is basically the result of several months of thinking about liquidity, because like liquidity in the world of VC and startups, this has been on everybody's mind for years. And I started out thinking like, okay, there's a problem here, and the private markets have changed, and companies can now stay private forever if they want to. So what does that mean for early stage investors and early employees? It creates an issue. Um, but then I realized if you have a company like OpenAI or Anduril is quite successful in private, there's plenty of liquidity. That's not actually the problem. I thought we were going to have to, let's try and build some infrastructure around private markets that doesn't yet exist, so that employees and early investors can have liquidity kind of like there used to be in the public markets back in the 90s. I don't actually think that's the issue anymore. There's kind of two things. One is there's just not that many companies that are really standalone long-term companies. Even Twitter and X is kind of like, maybe it should, maybe it shouldn't be. And two is that the last 4 years, M&A, basically companies getting bought by larger companies, has largely been turned off. And historically, that's about 3/4 of where you get liquidity in venture capital funds is from larger companies buying smaller companies. So one, that's going to get turned back on eventually. In fact, it's kind of coming back now. And two, if you have stock in a company like OpenAI, it doesn't really matter if it's public or not. You can find, as an early investor or early employee, you can find the liquidity you need to make a return in cash to your investors if you and they want to, or frankly, your investors are not necessarily upset at holding Stripe stock. It's a good company, it produces a lot of value over time. Maybe that private stock is just fine because they would have held it if it was public anyway. So what I'm kind of left with is, after talking to a bunch of people who are experienced in private equity and venture capital, is that not a lot has actually changed for VC, even though it kind of looks like it, because all this sort of, all this has changed about how much lending there is, and whether you can get $40 billion if you're a private company. Answer yes. Where you used to have to go to the public market. The Jobs Act means you can have 2,000 shareholders, which is kind of unlimited, because you can be clever with the law. All of that has changed, and yet venture capital is still about finding the outliers and owning stock and having the right to work with the outlier companies that are going to be long-term, standalone, multi-billion, deca-billion-dollar companies, and fund management. The less sexy work of knowing how and when to create liquidity for your investors in that process. And the Chime IPO is an interesting example of that. The Information did a chart recently which kind of encapsulates this entire thing in one chart, because it's a company that recently went public at a share price that's less than half of what its peak private share price was. And there's a lot of incentive not to go public when that's the case, when you have multiple rounds of late stage private investors who are going to lose money. They've already lost it. They're going to realize the loss when the share price becomes real, becomes liquid. But if you're an early stage investor and you sell at one of those late stage private valuations, the return to you and your investors is quite a bit greater than even the good investment you get from the public stock. If you're a mid-stage investor and you sell at that late stage, that's also great. If you're a mid-stage investor and you sell public, it's okay. You get a return, but it's not going to maybe define the venture scale returns that you hoped to get, right? So fundamentally, VC is the same game. Find the outliers, figure out how to create liquidity at the right moment. And the tools are there. It's not a structural problem. It's just really, really hard.